Good to see you again. I want to talk a little bit about mortgage interest rate shifts. We haven't had a huge shift. We've been staying 6, 7% pretty regularly, I would say. But there are fluctuation in mortgage interest rates, and it can be unsettling sometimes. So we'll just kind of give a little run through on this. I don't know when you'll be thinking about buying, but you'll start thinking about interest rates when you do. What affects the interest rate that lenders charge you? Why is it up and down and up and down, and mostly up, I guess? They're looking at economic conditions, which can be unsettling, the risk tolerance. Other factors could be including what the yield is on, like if you have a 10-year loan, 15-year loan, 25. But what the yearly bonds, treasury bonds are doing. If you have something like that, you would understand what happens with those. The price of the mortgage-backed securities can go up and down too. Your credit score, debt to income ratio, and down payment also impact your rate too, as long as these other conditions. And none of these conditions are anything you have a whole lot of that you can control on these. Even the things that are yours, because things happen that affect our credit score. Things happen that we need to borrow money for. It's just like, what's the difference between a fixed rate and adjustable rate? Well, a fixed rate keeps the same rate through the life of the loan. If you wanted to change that, you would have to go back and redo the loan. An adjustable rate mortgage, they usually call it the ARMs, may offer a lower initial payment, usually for 5 or 7 years, and then your rate could later be based on market conditions. But with an ARM, you get early money savings for a share of the interest rate risk on the road ahead. You don't know what's ahead. So you want to look at both of those. I would not let either one of those scare me away. Just so I know it, I understand it, and I can plan my money accordingly. That's the basic what you want to know. And what's included in your mortgage payment? And I'm going to tell you what's normal, but I didn't always let them put this in my mortgage. Some of them want to because they want to make sure it gets paid, basically. It'll be your loan amount, interest, property taxes, and homeowners insurance. So you can see they want to make sure you pay your taxes and that you're paying insurance on the home. I always kept mine separate. Number one, I may not want to keep the same property insurance that I had last year. Maybe they sent me some kind of notice that something's going to be different. And I don't want to keep it. So if I'm tied with the bank, I can't. And property taxes, they don't say the same either, do they? But most of them will want to wrap that all together. And you want to make sure that your payment is less than 20% of the purchase price, whatever that might be. That's also a number to stick with. Do higher interest rates affect your monthly mortgage payment? Yeah, they will. They will affect that. You need to find out how much, and you could shop around and get another mortgage. But if they're going up, chances are they're going up everywhere. What can you do to get the lowest rate? Shop around, improve the credit score, lock in a rate with somebody, and buy discount points. You can use money, buy down points. Start at let's say start at 6%, you can buy clear down to 3 or 4% if you have the money, depending on what it is. And mortgage things change widely, and rates change daily sometimes. So you need a trusted professional in that. It's good to get to know a mortgage company really well. You can buy other things with it besides a house, like, boat, vacation, whatever. So you get established at it. But you'll get the knack. Everybody does. It's new at first, but navigating a mortgage is something you're going to need to learn to do. Thank you for joining me. See you again soon. Linda Hollington, Public Bank of Paradise.